Hello, and welcome to our quarterly economic update. Market volatility again hits Q1, the tale of two wars. In 2025, we had the tariff wars, and now in 26, the Iran war. In both cases, the market has responded negatively, as one would expect. The notable change is that not all asset classes are doing poorly. At the date of this writing, we have seen a changing of the guard in market leaders. Diversification is continuing to help portfolios as value stocks, international, and small caps have led the way to positive returns. Growth stocks, led by technology, are dragging down the S&P 500 due to their oversized market cap share and are the losers year to date. We believe this does continue through 26 as the market fights through a third year of positive returns. We expect more volatility, not less, this year. In the Fed's last meeting, they chose to leave interest rates the same. Inflation has not subsided low enough, and with higher oil prices in the short term, the Fed chose to take a wait-and-see approach. 30-year mortgage rates did briefly hit below 6% in late February. We still see potential for mid-5% rates if the Fed lowers rates later this year. Much of our clients' attention has been on the Middle East and how it affects their portfolio. No one has a crystal ball and can predict the outcome of this conflict. The S&P 500 is down roughly 5% from the peak in early February. Not even in bear market territory, massive panic sell-offs have not taken place. The markets are interpreting the data to this point. The war is short-term, which is why the tariff war of 25 sparked a larger sell-off. The markets thought global trade was going to be completely disrupted. Instead, trade just adjusted and moved forward. Markets proceeded to recover. There was more uncertainty to global trade in the tariffs than the current Iran war. The Strait of Hormuz is very important to oil flows to the world, but it is not as catastrophic compared to the 1970s. A big reason is the US is now a net exporter of oil and natural gas. From our perspective, as long as oil remains elevated, the markets will struggle, giving us potential buying opportunities. If the conflict ends, we do expect oil prices to drop quickly and the markets to recover. History of wars and conflicts and the stock market bear this pattern out. The timing of how that plays out can't be predicted. Our team works through our TRIP process, keeping a diversified portfolio when navigating changing market conditions. We will continue monitoring the economic trends and evaluate any course corrections necessary as we navigate the geopolitical risk of the latest Middle East conflicts.